Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Fear and Greed is working with the team at trading platform moomoo on a series for investors. Every Friday, we're bringing you an episode exploring how to use technology and data for smarter investing. Today, it's all about using earnings data to make good investment decisions. Remember, the information in this episode is general in nature and doesn't take into account your own circumstances. Michael McCarthy is the Chief Commercial Officer and Market Strategist at trading platform moomoo, which is a fantastic supporter of this podcast. Michael, welcome back to Fear and Greed.
Thanks very much, Sean. Always love to be on my favourite podcast.
That sort of thing will get you a long, long way. Let's do a bit of investing 101 on earnings data. What do you look for when you go through companies' earnings? Because there's a lot of information there, Michael.
Exactly. And let me cut right through it, Sean. Study after study over decades has shown the surest predictor of share price movement is changes to earnings expectations, right? And that's why earnings reports are watched so closely. Statistically, we know when the market's view on the earnings of a company change, whether they go up or down, the share price tends to do the same thing. And that's why it's important to keep track of earnings, but also to keep track of earnings expectations. And that's what we do on the moomoo platform. Before a release, you can see what the market expects. As the numbers drop, you can immediately compare those earnings numbers, the key ones, the profit, the revenue, the cash flows, and get a quick idea of to whether or not that company has beaten earnings. Now, if you're an investor and you've got a long-term view, you might want to take in more information before you make your jump into the market. But if you've got short-term trading ideals, for example, you might want to be able to react immediately to any change to earnings expectations because of the impact that has on share prices.
Okay, so that's why sometimes you have a really poor result and the share price goes up, or a good result and the share price goes down. Doesn't seem to make sense, but it's as per expectations. How does the moomoo platform find those expectations? Is it all about what the company has said previously, or is it analyst consensus? How do you get those expectations?
Well, moomoo, through its global partnerships, has access to a lot of analyst recommendations, earnings reports, and earnings estimates. And we take consensus earnings estimates, right? The average of what all the analysts are saying to arrive at a consensus. Now, we're also aware that sometimes outliers could affect averages. We have our own proprietary algorithms that create what we see as the consensus. It's generally in line with what you'll see on professional trading platforms. So we're pretty confident about the numbers we're putting forward. But the market reaction is often a good gauge. And generally speaking, if we something well away from one of our numbers, either above or below the expectations we've estimated as consensus, we see the sort of market reaction we'd expect to see.
Okay, so there's instant access to company earnings data and also instant access to expectations. How important is that to get that quickly, early on, as opposed to worry about it in a week's time?
Well, if you're investing on a time frame of 10, 20, 40 years, if you're starting out in your working career, you might not be too worried about a simple quarterly or semi-annual report from an Australian company, a Hong Kong company, or a US company. But if you've got short-term trading interests, you might want to know instantly. It really depends on what the individual investor or trader is looking for. It's important. If you're trying to time an entry, you might have a stock on your watch list and you wait for the earnings report. And if it does miss earnings and you're investing for a long time frame, that might be good news for you because the share price falls and you get your long-term investment at a better price. If you're a trader and it misses and falls and you've gone in with positive expectations, you might be facing a bit of a loss in your trading account on that particular day. So whether or not a company beats its earnings and the reaction to that depends very much on the individual circumstances that everyone brings to the market themselves.
Okay, so interpreting these earnings reports against expectations, moomoo has visual tools, don't you, which actually helps you do that.
Absolutely right. We do price analysis too to show when shares have been bought or sold. We make analysis based on assumptions around which side of the bid-offer spread transactions are happening on, which we use to accompany the data. So the idea is to give investors a full suite of tools, if that's what they're looking for, to help them quickly understand the earnings analysis. But yes, straightforward graphs of some of the key metrics are also available. We aggregate them in ways that we believe make sense from an investment or trading point of view. Whether or not a particular tool that we've created is useful to you is a decision entirely for you.
Stay with me, Michael. We'll be back in a minute. My guest this morning is Michael McCarthy from moomoo. Okay, so let's think of it in a different way now. What are some of the common mistakes investors make when looking at earnings data?
Well, once again, it depends what investment goals are involved. But one mistake we often see is misreading the numbers, in particular profit numbers. Now, profit numbers can be impacted by a lot of one-off effects. So it's important to understand the headlines that are dropping with the numbers so that if the numbers are well away from expectations, you quickly get an idea of what's going on. So you'll see as earnings reports are dropping, a lot of news reports come through on the moomoo platform that are simply headlines because we understand that a speed of understanding around an earnings report is very important so investors can gauge the right reaction for them. So if, for example, a company has written down one of its key projects or one of the shareholdings that it has in another company has been has gone up in value and they want to report that, and that hits the earnings for that half year or quarter year, then people want to know what it is that's driving that big divergence from what they were expecting. Now, if it's just a bad operating result, that's very important. But if it's due to some one-off factors that aren't expected to recur, that's also important. And being able to gauge that quickly from the headlines that are dropping at the same time as the numbers adds a dimension of extra care around reacting to earnings reports.
I suppose something I always found as a journalist, it was sometimes really difficult to work out what the actual earnings report was saying. So you have net profit and you have underlying earnings, and when we have banks, you've got cash profits, and there's all sorts of bells and whistles that I'm probably totally wrong, Michael, but sometimes it doesn't seem that they're totally consistent between earnings season. How do you get through all that muck and know what to do?
Sean, let me let you in on a trader's secret. The harder an earnings report is to understand, the more likely it is management doesn't want you to understand it. It's something a little bit cynical perhaps, but it's often proven to be the case. If an earnings report is well away from expectations and is very complex and takes a lot of study to understand, that's a concern. Transparency is a virtue in the corporate world, just as it is in the government world. So anytime companies are less than transparent, it sets off alarm bells amongst analysts and professional investors.
And mostly when we're talking about write-downs, mostly they're announced ahead of the earnings results. So a company there's been one in the last couple of weeks, whereas I think it was a big miner wrote down an asset overseas, and that meant that they made a loss, which is fine, but that had been pre-announced. So mostly that sort of stuff's been pre-announced, hasn't it?
Generally speaking, it is, because most corporate boards these days follow the maxim that you under-promise and over-deliver when it comes to earnings. And that's what they're seeking to do. There are a couple of companies in the United States that are notorious for beating earnings estimates by 1 penny, as they say in the US, or 1 cent. So that's the structure that the management and leadership of companies are working to. They want to tell investors truly about what's happening in the company, but they tend to slightly underestimate. So when the time comes to deliver the numbers, they've over-delivered. And that can lead to some mistakes in the way they go about that. But it's one of the key reasons why big items are often reported ahead of the result. It's so that they don't come as a shock to the market and that too easily misinterpreted in what can sometimes be, a very heated up atmosphere around an earnings report for a major company.
We've talked lots in the last few weeks about moomoo's use of artificial intelligence, AI, using data to hopefully create much better investment decisions. So we do insist that all listeners should go and get advice when it comes to investing. How can investors use this earnings data we're talking about with all the other stuff that we've spoken about in the last week, be it AI, be it investment strategies, to kind of make a decision about how a firm is going?
It's a fair question. And one of the keys here is to understand that in the case of earnings report, AI is working behind the scenes. It's not your front of house tool that you're going to then feed data into and get a result from. The way we use AI in the case of earnings reports is to make most prominent what is most important. So often with, say, a large mining company reporting, it's actually the production report, the number of tons of ore or the ounces of gold that they've produced, rather than the actual cash flow and earnings and profit numbers. So we try and make those more prominent. Now, AI algorithms understand this, that the type of industry and the type of company it is can determine what are the most important numbers. So rather than having to sort that out yourself and go through pages and pages to pick out the key numbers, we use AI to bring those most important numbers to your attention. In other words, we do sensitivity analysis using computation power. And so we've got a profile of what we should be putting forward. Now, like any analysis, it's not 100% perfect. Sometimes even AI makes a mistake, believe it or not. But it does give you a better chance of, one, seeing the numbers that you need to see immediately and giving you a jump on those investors or traders who are still sorting their way through the full earnings report.
I suppose that's the point. It's immediate. So the result comes out, it hits the exchange, you know exactly what's going on as per your strategy, hopefully.
Well, that's right. So the key to it is what's important is put straight in front of you. It happens as the numbers drop, and you'll have the framework, the expectations around that number in front of you so that you've got a good idea what it is that you want to do when everything is right in front of you.
So if you've got the right strategy, technology, I'm guessing, Michael, is a big competitive advantage for an investor.
Absolutely. I mean, this started in the 1990s, Sean. I mean, that's how long automated trading has been a feature of the market landscape. And the developments over that almost 30-year period are very strong, deep and powerful. And to the point where we're now in a position to bring a lot of that power to individual investors. A lot of these tools were reserved only for professional investors who had the backing of large institutions that could make the investment necessary to build them. But with groups like technology first companies like moomoo, we're able to bring that to individual investors. And as I say, in a lot of cases, it works in the background. You don't have to have professional level expertise to understand what it is that Moomoo's AI is showing you around earnings reports.
I reckon that's exactly what I've learned over the past few weeks, Michael, is that the actual access, as a journalist, you could talk to analysts who had all sorts of computational power. But what I think is quite amazing now is it's an individual investor who can actually grab hold of that, which hasn't been the case really up until, well, certainly your platform, but until recent years, really, that's never been available to a retail investor, I would argue.
Oh, I'd absolutely concur. As a professional trader and investor for many years, decades to be frank, I've used almost every professional platform, plenty of proprietary platforms, and a lot of the retail platforms. This is the most powerful platform I've come across in the individual investor and trader space. It's at the cutting edge of technology for people who invest and trade the way I do.
Michael, thank you for talking to Fear and Greed.
Thank you, Sean.
That was Michael McCarthy from moomoo, a great supporter of this podcast. For more information on the moomoo platform, follow the link in today's show notes. And remember that information in this podcast is general in nature, and you should get professional advice and make sure a product is right for you before proceeding. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.